Today we're going to be trying something new. Usually I post a very fast-paced video, talk about a stock and get it done within 10 minutes. But that's not the type of content that I would typically watch. Instead, I'm more interested in the slower burners, the ones where you've got more time to pause and to think, and to really analyze an investment decision. So today on the channel, what I've done is I've decided to change things up. I'm going to be doing a stock analysis of MasterCard, what I think of the business model, what we can learn about it, and whether I think it is a good stock to add in a portfolio. And by doing this, we're going to be looking at various different topics, such as the business model, how MasterCard make money, what kind of fees do MasterCard charge versus their competition, a little bit about the management, what kind of people are running the company. We're also going to be looking at the standard key financial metrics. We'll be looking at earnings, free cash flow, what is the quality of the balance sheet, and we're also going to look about what some concerns are going forward. What's some of the news that are on the business right now? Is there something that we should be looking out for as potential investors in a company like MasterCard? So I hope instead you enjoy this more slower paced kind of a video, and if you do think this is perhaps better than usual, then drop one of those, as it is much appreciated, and lets those new viewers know what video is actually worthwhile watching, because on YouTube there is a lot of rubbish about, that is for sure. So first things first, what I like to do is look at the company webpage and look at who we are or what they have to say about themselves. Now it says here about MasterCard, always moving forward. Now that seems to be their slogan, and I quite like it, right? It aligns with what I would like to look for: aggregation of marginal gains, small improvements here and there to make differences longer term. Always moving forward suggests that they're looking to keep growing over time. Now, they've got quite a bit here, and what I'm really interested in is their purpose. We work to connect and power an inclusive digital economy that benefits everyone, everywhere. Our secure networks, partnerships, solutions, and innovations make transactions safe, simple, and smart, and help everyone realize their greatest potential. This, as a business, you can tell, has vision. You can tell they're looking to create a package deal here. They want to, as I say, create a very strong network or platform to encourage businesses, consumers to use it. They want to create the best product in order for more customers to join along. And it's a very, very basic business principle here, but also very, very key. Now they talk about here that they have a global vision with local values. Whether we operate worldwide, our team are united by MasterCard's corporate culture and a desire to meet the unique needs of local individuals and businesses. They mention here there's 4 main topics here. They've got their executive management, and that their executive management leads with MasterCard to innovate with purpose. They say that MasterCard operates from hundreds of corporate offices worldwide. We foster an inclusive culture because diverse perspectives build stronger teams. And they also mention that with projects both local and global, our employees make a lasting impact. A lot of businesses these days do single down on people. People is an important front. With good staff, you can make seriously good money. I've said before, and I'll say it again, as an employee of a business, an employee can deliver more than 10 times their salary in value to a business. As long as they feel appreciated and they work and they're motivated with the business, which is more than possible, then this can make a very attractive proposition. So it makes sense how they're also showing here that they're committed to their people, and this is how they're going to grow the business. So let's take a look at the annual report here, or known as a 10K since it's a US listed stock. Now I'm interested here on their strategy. There's a bit above here about their MasterCard branded programs, how much revenue they're making, or gross dollar value, as you can see, GDV here, and how much growth it's had. I'm more interested in the strategy, so we're going to jump into this first. And it says here, our strategy centers on growing our core payments network, diversifying our customers and geographies, and building capabilities for a combination of organic and inorganic strategic initiatives. So they're talking about here growing their own business in-house. What can they best do to improve their business model and reach out further, as well as look for inorganic strategic initiatives. So that's talking about mergers and acquisitions. What businesses can they purchase that might eliminate competition for themselves or might help them claw up market share in a new area with great synergy to the company? Very key points here. They say here that we are executing on this strategy through a focus on 3 key priorities. Expand in payments for consumers, businesses, and governments. Extend our services to enhance transactions and drive customer value. And embrace new network opportunities to enable open banking, digital identity, and other adjacent network capabilities. Each of our priorities supports and builds upon each other and are fundamentally interdependent. Again, they talk here, and it's very much easily aligned here in the image. It says their strategy is to grow the core, diversify into new customers and geographies, and then build new areas for the future. And as I've said before, it gives great synergy in what they do. By expanding in payments, they can also extend their services. And by doing that, they can also embrace new networks. And this is a kind of business here that as they grow in size, the economies of scale also grow stronger. So economies of scale, for those that aren't aware, is as a business gets bigger, they have certain advantages in place that put them in a better position than perhaps smaller competitors. This might be a bigger business being able to buy in bulk, because they're able to shift more volume of a certain product compared to the likes of a smaller business that has to buy individually because obviously they're not selling as much product. Now, this is quite obvious in the case of MasterCard because MasterCard is already a very large business, but I felt it important to bring this up because when investing in a company, I think you've really got to look at the direction. You've got to look at, can this business scale effectively? Is this a company that can keep growing over time? Does it almost have unlimited growth potential? Now, there's no such thing as unlimited growth potential, but the idea is there, the concept is there. Is this a business that is going to continue growing for the next 20 years? Now, it may have a point where it stops growing. There may be a point where you no longer align with such a business, but the concept, if you buy now with that vision, you can then adjust and change your mind later on if, of course, that does changes. And that's why we look at the idea of the management, we look at the business model, and we look at the product itself, what value this offers to customers. So I'm going to scroll down a bit here. Our key strategic priorities. They want to, as I say, expand in payments. We focus on expanding our core network payments to enable payment flows for consumers, businesses, governments, and others, providing them with a choice and flexibility to transact across multiple payment rails, including cards, real-time payments, account-to-account transactions, crypto, and others, while ensuring that all payments are safe, secure, and seamless. They do this by driving growth in consumer payments, with a focus on accelerating digitization, growing acceptance, and pursuing an expanded set of use cases through partnerships. They are capturing new payment flows by expanding their multi-rail capabilities and applications to penetrate key flows such as disbursements and remittances, commercial point of sale transaction, business to business or B2B, accounts payable flows, and consumer bill payments. So here we've got business to consumer with driving growth in consumer payments. We have got business to business in capturing new payment flows. Then they talk about leaning into payment innovations, such as our piloting in 2022 of MasterCard Installments, our buy now, pay later solution, and developing solutions that support digital currencies and blockchain applications. Now, I've latched on to the end bit here because buy now, pay now, or buy now, pay later has become a very popular front. You'll see this on most marketplaces. When you're looking to purchase a product, you'll notice that, okay, you can do this, or you can buy in 3 installments with 0% interest rate over a 6-month period, and you don't have to start buying or paying for this until the 3rd month in. It's very incentivizing because you see a lower price tag. So you as a consumer are going to be more likely to lean towards it. If I go, oh, you know what, I don't want to buy a sofa for £1,500, but actually, if I spend £500 a month for 3 months, well, that seems like a lot less. I therefore think it's cheaper. I'm more likely to spend more. You'll also notice that they've said that they're developing solutions that support digital currency, which is very meta at the moment. Everyone's talking about digital currencies, Bitcoin, cryptocurrency, and blockchain applications. Now that has potential for huge disruption in this space, and it's very key that MasterCard is very much aware of this and can obviously adapt where needed. They also talk about extending their services. Our services drive value for our customers and the broader payments ecosystem. These services include cyber and intelligence solutions, insights and analytics, consulting, marketing services, loyalty, processing, and payment gateway solutions for e-commerce merchants. As we drive value, our services generate revenue while helping to accelerate our overall financial performance by supporting revenue growth in payments and new network opportunities. We extend our services by enhancing the value of payments, by making payments safe, secure, intelligent, and seamless, by removing that risk of, let's say you were initially doing a cash transaction. This is more appealing, especially in a business to business transaction, but we'll talk more on their model on how they make money a little bit later on. Expanding services to new segments and use cases to address the needs of a larger set of customers, including financial institutions, merchants, governments, digital players, and others, while expanding our geographical reach. We're looking for global expansion here. This is already a very large brand that is already diversified worldwide. So how can they further grow their revenue? How can they further increase the profits and therefore keep shareholders happy? They also talk about supporting and strengthening new network capabilities, including expanding services associated with digital identities and deploying our expertise in open banking and open data, including with improved analytics. Open banking is very popular at the moment. The idea here that you can get the necessary information required to you as a consumer or as a business has plenty of use case. With this information available to you, you're able to do different forms of analysis. Now, as a consumer, you may want to be able to do this analysis on what you're spending as a customer without having to download bank statements. You might want to connect all of your different bank accounts into one place, analyze the data in one without having to do a lot of the legwork. Open banking helps in this regard. I can't quite talk for how this might impact businesses, but if you imagine the volume of transactions is far greater and perhaps the diversity between the different types of data sources and the kind of information that they hold, I'd imagine that open banking can help out a lot here. But it does talk on more of this. Embrace new network opportunities. We're building and managing new adjacent network capabilities to power commerce and payments, creating new opportunities to develop and embed services. We do so by applying our open banking solutions to help institutions and individuals exchange consumer permission data securely and easily by enabling the reliable access, transmission, and management of consumer including for opening new accounts, securing loans, increasing credit scores, and enabling consumer choice in money movement and personal finance management. That personal finance management part is what I was talking about in particular there, but you can see that another key part of this is the security of it. The fact that it's secure, that you're able to get this data almost seamlessly, means that, again, there's another avid point for this. But this is not unique to MasterCard, but it is key. It's key that they obviously focus in on this area because it provides them more value as a business. Now, enabling digital identity solutions to instill trust in the digital world and ensure that payments across consumers, companies, devices, and virtual entities are efficient, safe, and secure. We're talking about security again here. Is very important when obviously you are the payment network. And it says here that each of our priorities supports and builds upon each other and are fundamentally interdependent. Payments provide data and distribution to drive scale and differentiation in services and enable the development and adaptation or adoption of new network capabilities. Services improve the security, efficiency, and intelligence of payments, improve portfolio performance, differentiate our offerings, strengthen our customer relationships, and support our open banking and digital identity platforms. New network opportunities strengthen our digital payments value proposition, including improved authentication with digital identity and new opportunities to develop and embed services in our expanding product offerings. So you have this payment network here. You're able to provide the data, distribution, have at large scale, perhaps with a high volume of transactions. But you've also said here that by improving the security, by improving the checks on digital identity, implementing secure checks to make sure the person making this transaction is them and it's not fraud, this becomes a much more valuable platform. And this is how they're also going to make money. You're going to pay for security, just like you're going to pay for a more expensive delivery if it means that it's insured or if it means that it's signed for, because you've got a bit more certainty on the overall outlook of it. It says here that they've got 6 key drivers for success. They say, and this is what I like to look at for really the key picture behind the business. What do they focus on as a business? Are they similar to other companies, or are they unique in what they believe power their success? So they talk about people. Our success is driven by the skills, experience, integrity, and mindset of our people. We attract and retain top talent from diverse backgrounds and industries. Our people and our winning culture is based on decency, respect, and inclusion, where people have opportunities to perform purpose-driven work that impacts communities, customers, and co-workers on a global scale. The diversity and skill sets of our people underpin everything we do. Brand. Our brands and brand identities serve as a differentiator for our businesses, representing our values and enabling us to accelerate growth in new areas. Data. We use our data assets, infrastructure, and platforms to create a range of products and services for our customers, while incorporating our data principles in how we design, implement, and deliver those solutions. Our privacy by design and data by design processes have been developed to ensure we embed privacy, security, and data controls in all of our products and services, keeping a clear focus on protecting customers and individuals' data. Now, as the adoption of the internet and as more transactions take place online or via a network, security or digital to security has become very much a popular cause. You will look at kinds of companies, let's say Darktrace in the United Kingdom, for example, that had gotten a lot of excitement and hype around their initial public offering or listing to the public markets because of digital security, because of that cyber defense. And this is why it's so key. And you can see here, because they've got a clear focus on protecting customers and individuals' data, what's key about this is that you can have some serious knockbacks if this gets released. And that brand security that you once had with MasterCard or Visa is now gone. And it's not really you as the consumer that's going to change here. It's the banks. It's the issuing banks that go, okay, MasterCard has just had a leak of all of their customers' data. This isn't good. Their brand can't be trusted. Now, some banks might stay, but the other banks might go, we're going to shift to the competitor. We're going to move to Visa here because we think Visa is more secure. They're more advanced here, and they're more looking at the security of the business. Therefore, data is key. Cybersecurity is key. Technology. Our technology provides resiliency, scalability, and flexibility in how we serve customers. It enables broader reach to scale digital payment services to multiple channels, including mobile devices. Our technology, standards, services, and governance model help us to serve the connection that allows financial institutions, financial technology companies, fintechs, and others to interoperate and enable consumers, businesses, governments, and merchants to engage through digital channels. Franchise. We manage an ecosystem of stakeholders who participate in our network. Our franchise creates and sustains a comprehensive series of value exchanges across our ecosystem. We provide a balanced ecosystem where all participants benefit from the availability, innovation, and safety and security of our network and platforms. Our franchise enables the scale of our payments network and helps ensure that our multiple payment capabilities operate under a single governance structure, which can be extended to new opportunities. Very good for control here, but also those that perhaps don't have enough of an infrastructure to be involved. By offering the franchise element, it gives more control to MasterCard, but more of a door to be open to use their payment network. Doing well by doing good. Sustainable impact is fundamental to our business strategy, and we leverage our employees, technology, resources, partnerships, and expertise to address social, economic, and environmental challenges. Our environmental, social, and governance priorities are expressed through 3 pillars: people, prosperity, planet. And all of the work we do is grounded in strong governance principles. I'm not so much interested in the regards of sustainable impact, or ESG. It's very much a buzzword at the moment. So let's look at some of their financial results. Let's look how MasterCard makes money as a business. We've looked about their values. We've looked at their business model. How does MasterCard make money? What is their revenue? What is their net revenue here? Now it says here that their revenue is made up of payment network and value-added services and solution. In 2022, net revenue increased 18% versus the comparable period in 2021. So on a 1-year like-for-like basis, net revenue increased 18%. When we look at their payment network here, the increase was actually 20%. So what it's showing here is that actually, in terms of net revenue, the growth was driven primarily by the payment network. That said, the value-added services and solutions has also had some good drive here, and it is also up by 14% on a 1-year like-for-like basis. The increase in net revenue was attributable to both our payment network and our value-added services and solutions, and included 1 percentage point of growth from acquisitions. Net revenue includes 13.1 billion of rebates. That can't be right. It may be, and incentives provided to our customers, an increase of 19% or 23% on a currency neutral basis in 2022 versus 2021. I tripped over for a second there, but we got there in the end. So let's go down a little bit further. We're going to look here a little bit more about how the operational impact was. So this table is driver of change. The following table summarizes the driver of change in net revenue. There are some things to note here. The one includes impacts from our key drivers and metrics offset by rebates and initiatives. So when we exclude acquisitions and we primarily look at the operational impact of the business model, they have suggested here that they've had a 26% increase in their payment network on a 1-year basis, year over year. It also suggests here that their value and added services and solutions is up 15% on a 1-year like-for-like basis. However, acquisitions in this space of value-added services and solutions have had an impact of 4%. That said, across the board, the currency impact is negative, and the net revenue is impacted by 5 percentage points here to the negative side. So overall, it leads them to a net revenue growth of that 18%, as we mentioned before. And I believe here on the right-hand side is the currency or the non-currency impact. So actually, the raw net revenue had grown by 23% when you exclude the currency impact that had occurred. So when we look actually at the payment network, excluding currency impact, you've got a 21% increase in 2021. Or a 20% increase in 2022. This is showing a business that is continuing to grow. Despite their scale, we were talking about a very large amount, they are able to continue to grow. So how does MasterCard make their money? What do they do in order to make these high levels of money in their payment network? Well, there's a very good image I've got here, and sums this up very easily. You've got credit and debit card transactions. Now let's start with MasterCard. You've got an issuer, the issuing bank that we spoke about earlier, the one that offers the card. This issuer is going to say, okay, our bank would like to have a credit card, but we need a company to process the payments. We need to use a core network in order to do this. We want some security, but we also want a network that can seamlessly transact between multitudes of banks. We're going to go to MasterCard. So therefore, you've got the account holder, which has a card via the issuer that has MasterCard. So as the account holder, or you or I, decides to make a transaction, what ends up happening is it goes through the issuing bank, through MasterCard's network, which then goes to the acquirer's network, then goes to the merchant. So we'll receive the physical goods and products in person if we're, let's say, shopping at the high street. and the merchant will receive the money as it goes through the banks, and they'll receive the data for this. Now, interestingly here, it says that MasterCard pays markup fees to the payment processor and the acquiring bank. And it says MasterCard keeps an assessment fee, which is 0.1, let's round it up, 4% for transactions less than $1,000. So that is how MasterCard makes money. They're effectively the middleman here, and they take such a small percentage fee that you can't argue with it. It provides a value to businesses and consumers. It gives greater security. It allows these banks to, invest in their other operations rather than invest in this network to transact. And effectively here, MasterCard can take a very, very small slice of every single transaction, but because the gross dollar value is so high, they can make lots and lots in revenue. And truth be told, what's going to be driving growth in this industry? Well, driving growth here would be an increase and a trend that, quite frankly, cash is not going to be fighting back here, is the increase in people making card transactions. People making transactions with Visa or MasterCard. Now, you might go at the moment and go, well, hang on, what about the likes of Google and Apple Pay? Aren't they effectively bypassing Visa and MasterCard? Well, that's true. However, they're not fully bypassing this. If security is to be added on a retailer end perspective, MasterCard and Visa still offer the likes of, with Visa, 3D Secure. They have to authorize fraud protection. This is one element where a business like this has another way of getting around it. Now, you might be making a purchase with Google Pay and you've bought a product online. In fact, someone else has bought a product using your card online on Google Pay. Well, obviously that's fraud. You want your money back, so you're going to charge it back with your bank. You'll get your money back. But what about the retailer? What about the merchant that's just had the money taken back from them due to a chargeback and has also had the product shipped out to another person? What can they do? Well, of course, they're going to want their money back as well. So this becomes the liability of the likes of MasterCard or Visa and or the customer. So what needs to be done here? Well, are we going to find the individual that, let's say, paid for this transaction somewhere across the globe? Potentially. Is that going to take a lot in investigative fees? Potentially, depending on the business model. You might have a cut and dry case where someone walks into a shop, visible on CCTV, clearly presents the card and signs their signature, in which case you could very much dispute the chargeback and perhaps win as a retailer. However, if, of course, that's not possible, you want security. You want the likes of MasterCard and Visa to offer you some kind of fraud protection that means no one could just pick up a random card and just start spending willy-nilly. Now, of course, you can do that in terms of contactless payments, and you can do it so much. But don't forget, every now and again, it will reject it, or if they do believe spending's a little bit off by the bank, they will also reject that, and then you have to enter your PIN. So there is an element of security there that is important. When we look at market share, now we've got credit market share, and every link that I'm looking at currently will be in the description of the video down below. And if you haven't already, don't forget to click that subscribe button because it will show me that you want to see more content like this, a little bit more of a deeper dive on these kind of stocks, a slower pace, something you can sort of chuckle on in the background as you're doing other things and analyze. So on this website here, on balancingeverything.com, we're talking about credit card market shares. So we're going back to this fee here with the core network on credit and debit card transactions. Now it says here, global credit market share by purchase transactions. It says here that in 2021, Visa's market share was 39%. The runner-up was UnionPay with a slightly lower market share of 34%. MasterCard was the third most popular brand worldwide, and this brand stood behind 24% of all credit card transactions. So in terms of market share on purchase transactions, MasterCard is obviously in third place. That said, they've still got a quarter of the market, and it means they have got more room for growth. Is this business more disruptive? Are they able to push through? When we look at actually the purchase transaction value, Visa has a much similar advantage as they do with the one above. Again, Visa processed 185.5 purchase transactions. This is in billions, by the way. UnionPay had second place with 131.3 billion transactions, and MasterCard processed 108.4 billion transactions in 2019. I'm going to scroll down here a bit. Now, there's market share of card brands in Europe. In Europe, Visa was the leading card in terms of market share between 2015 and 2020. Its dominance, however, has been weakening as MasterCard's client base has started to improve. Between 2015 and 2020, the market share of Visa across Europe dropped by 10%. In 2015, Visa dominated the market with a market share of 68%. In the next 4 years, it declined, or all the way down to 2020, it declined to 58%. That is a large drop in Europe. That is a huge change of play here and suggests something's going on here. Something is going right or wrong for either another company or wrong for Visa. MasterCard, by contrast, saw its market share jump by 12% in the same period. In 2015, the company held 29% of the total purchase volume in Europe. In 2020, they hit 41%. Notice how even in Europe, MasterCard had the edge because they held 29% here versus the global network where they were holding 24%. So clearly they've had some significant growth here, and MasterCard obviously having a 41% market share is big. It's a push for the positive. And it's a question really, what are they doing differently? How does MasterCard charge fees that might make them more advantageous versus that of Visa? Well, I've got this here. This was created by Altex Soft, their software and R&D engineering. And it says processing fees by credit card networks and third-party processors. We've got two types of fees here. We've got the interchange fee and the assessment fee. Now, the assessment fee we were talking about earlier on, which is the idea here that this is the markup fees to the payment processor and the acquiring bank. And you can see here that we spoke about MasterCard earlier. When it's less than $1,000, is a 0.13% fee. Excuse me, I'm going to have a drink of water. Visa is actually very similar in this regard. They also have a 0.13% fee for debit cards and a 0.14% fee for credit cards. So when more than $1,000 is charged, there is a 0.14% fee for credit cards on the assessment for MasterCard and a 0.13% for debit. So realistically, and you can see really across the board here, when we look at Discover, we look at American Express, the percentages are very similar. This part of it, the assessment fees here look extremely competitive. So there isn't really too much in the scope of growth here because it seems very much locked in. However, when we look at interchange fees, which seem to be the most important here, you can see how there's quite a bit of variation between the brands' offerings. Notably, Discover and American Express don't publish as they're negotiable, but the likes of Visa and MasterCard have vastly differing fees. Now, Visa opts for a higher percentage fee for debit cards here. So the idea here is that on percentage-based transactions, they'll be taking a higher value of debit card transactions. That's what they're doing as a percentage. So the larger this debit card transaction is, the larger of a fee Visa get. However, when you swap this to credit cards, they've actually flipped it the other way. They've got a very, very low percentage fee for credit cards and a slightly higher fixed fee for them. So what it's showing here is they're almost taking a lot of money from debit card users, perhaps due to the lessened security. They're going to take more fees here, and I'm only really guessing. But they're going to take less on credit cards. They're incentivizing high purchases through credit cards. Perhaps because credit cards might have a higher overall level of spend. Now, I can't confirm that. I haven't checked the data for this. But perhaps more in a business or corporate use, you're going to be using credit cards for expenses, and perhaps those are going to be significantly higher. So when you're advertising more to a business rather than, let's say, the consumer, they might get a higher fee off of this. MasterCard charge a lower fee for debit cards, but a higher fee for credit cards in terms of percentage alone. But they also levy a fairly high interchange fee per transaction. So that is quite on the higher end here, and obviously is actually higher than all the rest of the competition. So this probably isn't great in a volumes-based business, a business that is transacting many times with a low average basket value, a business that might be selling, let's say, the pick and mix sweets. They might have loads of customers all buying £2 to £3 of sweets, but obviously MasterCard is going to be taking quite a high fee per transaction from this, whereas Visa might have a higher percentage fee, but in this case, since the transactional value is low, they're not getting as much as MasterCard in this regard. So what is really most constructive for business here? And you might argue in terms of Visa, their percentages, especially for credit cards, is better. That said, there's got to be a point or a balance where perhaps MasterCard is more attractive because of their percentage fee. And because obviously the larger your transaction is, that fixed fee is no longer that important. Suddenly that fee is a lot less than it seems to be. That is effectively the processing fees for these credit card networks. So let's jump into a bit of the financials. Let's look at the company. Let's look at the interesting stock analysis level of this. So we're on Simply Wall Street today. We can look at the valuation to start. Let's see what Simply Wall Street has to offer. Actually, let's go up a little bit. I think this is a better summary overall. So we've got founded in 1966. They have 29,900 employees. Currently, the fundamental summary, they are trading at a price to earnings ratio of 34 times. Now, this is certainly on the premium end of the spectrum. 34 times is not cheap by any means. This means really, if you wanted to recover back the earnings of the current share price, you have to hold this company for 34 years to get the earnings to reach the market capitalization of the share. It's very pricey. Typically, historically, on average, the markets have had a mean price to earnings ratio, the S&P 500, I think of about 15 times. But that's going back over a larger historical period. What's not to say that that average is higher nowadays? What's not to say it's not 16 or 17 times? Even with that change, we have got mean reversion against us because the likes of MasterCard here is sitting at a very hefty price to earnings ratio, very hefty indeed. But it is a financial business, and these kind of companies, I don't like to use earnings. I prefer to use free cash flow. I just think it makes a lot more sense. In the case of MasterCard, there's not much of a difference here, so it is still a premium. But let's say you've got these bank-style companies or banking companies. Sometimes they're going to have very low earnings, but they're going to have high levels of cash flow. I'd use the cash flow as my case for judgment. When we look at the earnings and revenue history over the last 5 years, on average, they've managed to grow their earnings by 14.7% each year. That is some impressive growth for a company that has a market capitalization of $340 billion. And you can see here that over time, even during the pandemic, when transactions were less, when lockdowns were rife, revenue declined, $1.5 billion. Earnings by about the same, right? And then it seemed to have rebounded very well. And you can see here that as revenue grows, earnings grow at a faster pace. The profit margins are getting higher over time, with the exception of late 2022, where it seems to be steeping off a little bit here. But this is some remarkable growth and some very high profit margins here, 44.7%. Very, very high, very cash flow friendly, and this is obviously one of the reasons that it is traded at a premium. You can see here that the revenue is obviously $22.2 billion. The cost of revenue is actually $0. They've got no revenue expenses here. So all of that is effectively gross profit. But they do have other expenses which then cut into their earnings of $9.9 billion. When we look again at valuation, we talk a little bit deeper. Let's look at perhaps a price to sales ratio. You're still looking at 15.2 times. If we compare this to the competition, and we're going back to price to earnings here, MasterCard is 3.3 times in terms of the price to earnings ratio, more premium than Visa, but less premium than PayPal, which is interesting. When we go to price to sales, you'll see a similar trend here, that obviously MasterCard is slightly more expensive than Visa, but they are both very, very pricey. What about financial health? What is the business on? Have they got a good position? Have they got minimal debt and high levels of cash? Let's have a look. So on the financial health of the business, MasterCard have quite a high level of debt to equity. And in fact, over time, their debt to equity ratio has increased. So you can see it's jumped up massively in 2020 here to where it's almost double the amount of debt to equity. But before that, it was doing quite well. That said, their cash position is very strong as well. So when we look at the most recent update, which is actually the same as the 10K that we were reading earlier, MasterCard's cash position is $7.4 billion. Whilst their debt is $14 billion, their equity is $6.3 billion. So at least they have a huge chunk of debt. And when we go back to their earnings, don't forget their past performance. Their free cash flow here is about the same as earnings. It's 10.1 billion a year. We go back to financial health, we look at the debt. Cash flow alone can cover this in 1 and a bit years. This, whilst on the balance sheet seems like a high level of debt to equity, when you compare it to its scale, the size and sheer volume, or not volume, but scale of their cash flow, it's less of a concern. You might go, okay, at first glance, MasterCard's balance sheet doesn't look too good here. But when you appreciate how big their cash flow is and how they could pay this down if they so choose to, it becomes a different story. It becomes more attractive as an investment, much more attractive. And this is because they are regularly distributing their surplus cash and capital in the form of buybacks, but also in the form of dividends. So if we search for dividend policy on the 10K, maybe we won't be so lucky. Let's keep looking through. So you can see here, if I go up slightly, in their performance, they had $8.8 billion of repurchased shares. That is a hefty level of share buybacks. And they also paid out $1.9 billion as dividends. So in total, they returned $10.7 billion in capital that was returned to shareholders, as they have highlighted here. Remember, that debt level of $14 billion, they've already paid out $10 billion to shareholders. They really can handle it. When we look at the dividend in particular, we can see that it is a low dividend yield of 0.6%. Simply Wall Street simply doesn't like it because it's a low yield. But low yields can often be a good investment. When a company has a lower dividend yield, this suggests that perhaps they're either growing it at a very low pace compared to the price of the shares, or perhaps here the market price of the shares have increased at a greater rate than the dividend growth. And if the dividend growth is quite high, that could be some kind of a positive sign. So a 0.6% dividend yield might annoy some dividend investors, some that are looking for some extra cash flow, but those perhaps earlier in their investment journey may appreciate the dividend, but also the majority in share buybacks, the majority in that capital growth element of the company. The best thing to see here actually is that their payout ratio is 20%. This means that of their total earnings, only 20% of it goes towards a dividend payment. The other 80% of it can be reinvested back into the business or paid as a share buyback, as mentioned. Whilst the yield is less than the industry average, which I'm guessing is looking at Visa for this, it's still not bad. But again, you're not really seeking dividends when you invest in a company like this. And we can see over time here, the stability and growth of payments is a great staircase. When you're looking for a company that pays a reliable dividend over time, you want to see that staircase of payments, that constant upwards staircase over time. Even during the pandemic in 2020, where a lot of businesses were shut down, a lot of dividends were being cut, look, they managed to increase their dividend price per share from $1.3 per share to $1.6 per share. And it keeps going up. Currently, they're now paying $2.3 a share. So in the past 2 to 3 years, it's increased by half a dollar more per share in the last few years. So this is some very fast dividend growth. In fact, well, I say very fast. In 2012, their dividend per share was about $1.2. No, actually, much less than that. Excuse me. So their dividend was $1 in 2018. It's now $2.2. So their dividend has doubled in like 5 years. You go back much further than that, and it's in fact more than 20 times increased in about 8 or so years. So their dividend growth is extremely fast. Sure, this is not where you're going to see a majority of your returns driven to you, but over time that's going to compound, and your average that you initially bought in the company is going to improve with time. Let's take a little look at the management of the company here. Let's see their compensation, their ownership. Do they have skin in the game? When we look at ownership here, we can see obviously the breakdown. There's not really much regarding individual insiders. The majority is held by institutions, 87.9% of the total share pool, and the general public own about 11.5%. Of the largest shareholders, there are no individual siders mentioned on there. You've got the MasterCard Foundation endowment arm. You've got the Vanguard Group, BlackRock, the usual businesses that own significant stakes. So in the leadership team, let's have a look at the CEO. The CEO is 54 years of old, 54 years of age, has had a tenure of 3 years, and is getting a compensation of $16 million per year. I mean, can you blame him when you make that much? However, considering he's had a 3-year tenure, his company ownership is $9.5 million. So less than half his annual salary he owns in shares here in terms of ownership. He's been with the company for 3 years. There's not really much skin in the game, which can create a disconnect between management and that of shareholders. So he needs a way of incentivizing himself with long-term incentive plans to incentivize the management to obviously align with shareholders, to focus on profits, to improve the business operations, and therefore improve profits. Mr. Michael Maybach, I can't pronounce that, correct me if I'm wrong, serves as president of MasterCard Incorporated from the 1st of March 2020. He's been the chief executive officer and director of MasterCard since 2021. He served as the chief product officer since January 2016 until March 2020. He has a wealth of insights and global experience from a career in payments and retail banking to drive customer-focused innovation and deliver solutions that provide more than just a transaction. He was a general manager for Middle East and Africa at MasterCard International since 2010. Again, it goes back quite far. It says here he was managing director Middle East and North Africa at Barclays Bank PLC, and that was in 2008. So he's been with the company for quite some time. His tenure was 3 years. His actual length of service with MasterCard is quite good. You'd want someone with a lot of experience, which you can certainly see here, and you want people with perhaps a longer term of employment. Those that stay with the business for a longer period of time are more aligned with the business. They understand the company values, and they're also perhaps more loyal to the business. They're more pushing towards a greater business, and it's that kind of employee culture that's key. That goes back to their point on people that we were looking at earlier today, where how people is a huge point of MasterCard and how they drive revenue growth. Let's look at the chief financial officer, Sasha Mehra. Again, I'm not getting these names correct. A tenure of nearly 4 years, aged 51. Has been the chief financial officer since April 2019. Has been the group executive of global commercial products at MasterCard since October 2015. Was a business financial officer of the North America region at MasterCard Worldwide from 2013 and a corporate treasurer of MasterCard Worldwide from June 2010. He was a vice president and treasurer of Hess Corporation since 2008. So again, quite a long length of service here. Again, we're looking at 13 odd years with the company at a minimum. Was formerly a deputy treasurer at Treasury and Risk Management at Citigroup and 40 under 40 list of up-and-coming financial executives for 4 years. These people seem quite promising there. Very much so, because obviously we're in such a large business of this size. And now there's obviously a lot more you could read on this. The compensation, probably quite high. But again, when you're in a business of this size, you want those kind of people aligned with the business. So what is my view here on MasterCard stock? And truthfully, I think really as a business, they're very pricey. But you pay that premium for perhaps quality. And with that in mind, you can decide here, is this a fair value to purchase shares of MasterCard? You're currently looking at a share price of, let me just scroll up again, I've got to go all the way up. You're looking at a share price of $300 and about $50 a share at the moment. It's quite pricey. That 34 times price to earnings and free cash flow ratio. This is higher than that of Visa as well. That said, I think you can pay up for premium. With a company that is very dominant with a strong moat, they're a middleman here. They're not easily cut out. They've got good market share across the globe. They're not the number one, but they are certainly the top 3. I think that's key. I think that's a good business model there. They've also shown that they're growing market share in Europe, as I mentioned earlier. That's also promising. We've seen that in that time, the leading market share, which was Visa, has actually been losing market share in Europe. So perhaps there's something going on there. In terms of fees, as we've spoken about before, there's more of a balance. It's certainly a lot more even between the two businesses, and something to discuss. When we look at the people, the management, and what they value, again, it's very hard to decipher this because a lot of businesses put out a lot of the same jargon. And truthfully, I think I would need to read more of the annual financial report to really get behind what the management focus on, what they truly mean when they push for greater results, what they want from the business. I personally have bought shares of MasterCard. As of this video, I hold 2 shares. So I appreciate it's not very much in the grand scheme of things. That said, I think it is a fantastic business with a very good moat. But truth be told, when I've analysed both Visa and MasterCard, I couldn't quite tell which one to buy. Because I think you've got to go into almost a molecular depth to really understand the difference here. And I think that goes beyond complexity. When you deep dive this kind of business, it's not an easy to understand business. On a top-down level, you can sort of go, yes, payment network, yes, okay, data and services and analytics. Kind of makes sense. I get what they're kind of doing here. But when you start trying to break that down, things get complicated fairly quickly. And I, as an individual, like to hold shares of a stock in which I could explain this to a 5-year-old. I've never had the opportunity or the thrill of that kind of a chat trying to explain the intricacies of MasterCard's business model to a 5-year-old. I don't think they'd be that much interested, or maybe I'm wrong. But if I were to be in that situation, could I break that down? By understanding that, I could then think more logically about share price movements, could have a greater understanding of why perhaps the share price is only up 1% over the last year compared to the wider market. I could then go forward and go, okay, I've looked at the shares. I know why they're down. I think now is a good time to buy, and I know roughly what I think is a fair price or valuation for this business. By looking at this business in the terms of owning it as a whole business, perhaps you can have a better outlook overall. There are some concerns I want to mention quickly. So when we look at this, and let me just adjust this article here, we've got MasterCard and Visa face multi-billion-pound claim for overcharging UK businesses. We're talking about those interchange fees again. It's a very brief article, but basically they're facing a minimum of £7.5 billion compensation claim worth from businesses accusing the payment processing companies of overcharging for their services. A law firm is set to file a claim, and realistically, this is averaging, their payment is taking about 2% of any given transaction value. So basically here, because they control so much, especially because they hold 98% of the UK's payment market share collectively and 80% of US transactions too, they're almost in a place of a duopoly where they can sort of keep charging higher fees. And perhaps a lot of their growth is from charging higher fees over time, which is not always what you want to hear because it's not that organic growth that you're after. It's almost inorganic. So they're charging a little bit more, but consumers and businesses can't really do anything about it. In my own experience of working in the wider world, our interaction as a business in finance is that, okay, there's not really much we can do here. MasterCard and Visa are leveraging increased fees. We're not contracted with them. Therefore, we can't really fight these fees. We have to just take them on. And sometimes they can be quite large increases as well. And because they are so vital, integral to the business to consumer process, business to business, really, you can't change much elsewhere. And Visa and MasterCard are quite similar in that regard, that they're both going to be sharing very similar fees with different advantages. But realistically, between the two, it's probably a very tough decision. And that goes back to my point here. Whilst obviously there's concerns of regulation, there is concerns that Visa and MasterCard are increasing their fees. As a two businesses, I find it very hard to differentiate the two. One is substantially larger than the other, and one has a greater market share in the United States. But realistically, in a portfolio, if I had the option or wanted to, I'd probably look at purchasing both Visa and MasterCard in a portfolio, holding both of them. Sometimes it could be better to bet on 2 horses to win the race rather than just one. knowing that you've got a decent exposure to this industry, in which this industry, its biggest competitor is cash, it's likely going to beat cash. Cash is not fighting back. Cash is going to lose the battle over time against card payments. MasterCard and Visa are in a fantastic place to take advantage of this. As cash dwindles, MasterCard and Visa have got space to grow. By owning both of them, perhaps you can give yourself that in your portfolio, that diversification that's needed. As I said before, I personally hold 2 shares of MasterCard as of this video. I'd like to increase this position. This is a very, very small position compared to the relative size of my portfolio, but I'm slowly scaling up as I try to gain a greater sense in the valuation of a business. Now, you might go, okay, Oz, we've watched so far, but what do I value MasterCard's business? What is the share price value? Fair price, share price, I like that. Truth be told, I don't set share price targets. Some people do, and it works for some. I personally don't believe in it. Mainly because it's very hard to quantify businesses, to say, okay, this segment of the business is worth this much, this segment is worth this much, especially when you don't have access to the internal information that is available. If I worked for MasterCard and I had access to the information, I could obviously analyze the value of all of their property. I can analyze the value of all of their assets and work it out much fairly, but I don't. Instead, I've got to look at it as a business. How can it grow? And right now, as a price, is it likely to revert to the mean of 15 times price to earnings ratio? Well, I'd figure not. At the worst, if this is a potentially very premium price, it hasn't seen much of a decline over the last year, perhaps due to its more resilient business model, I can scale in slowly over time. In my opinion, this is more of a defensive position. It's growing, and it's growing at a good speed for a business of its size, but it's not going to be growing the fastest around. It's not going to be growing significantly faster than other companies. Instead, I would look and add this in my portfolio, as I have, as a defensive position that gives me a little bit less volatility overall in my portfolio and a bit more consistency, that growing dividend over time, alongside some room for capital growth where it's not poorly invested. That way I can go, okay, look, 10% or whatever of my portfolio is allocated to MasterCard. It's a cracking business. It's got a great moat. It's got high barriers to entry to the industry. I have faith, and I'll leave it to that. That concludes my thoughts on MasterCard stock here. Obviously, I didn't go into an extremely deep dive, but I thought this would be a different style of video. I thought it'd be more interesting, a bit more relaxed, a bit more slower paced, a much longer video, but really just taking the time to sit and think about a company like this. I personally prefer doing something like this. In the shorter videos where I had 7 minutes, I had to give the illusion that I understand everything about business, and I had to understand it in 7 minutes. For me, it doesn't really work, because there's some things I straight up don't know. And quite frankly, I'd rather read and understand it collectively than try and pretend like I understand it and relay that onto you. I think understanding is key in your investments. And if you don't understand what you're invested in, then your conviction is going to be at disarray. You don't understand what you've bought, you're going to have a small bit of volatility. You're going to go, what's going on here? I'm going to panic, and you're going to react with emotion rather than logic. Thank you for watching. Again, if you haven't already, definitely click that subscribe button. I'd appreciate to see if any of you are actually watching at this point, to leave a comment. Let's just say, I'm going to put the word goose. If you type in the word goose from the comment, I'll heart it, and I'll know that you've made it this far to the video, because fair play. It's a long old video, and I don't normally do this on the channel. Thank you for watching. Have a fantastic day.